The U.S. economy is sure to feature in President Obama's nomination speech tomorrow. I want to speak to one man who thinks the world's largest economy is recovering faster than many people think. He is Pierre Mouton, portfolio manager at Knott, Stuckey & Co., where he oversees some $1 billion US. Joins me now from Geneva. And so why do you think that actually the U.S. economy is doing a little bit better than expected? Because it seems as though over the last few months, maybe the recovery is losing a bit of steam. We had some very poor manufacturing data come in yesterday, and expectations aren't very high for the jobs figure this week.
Good morning. Well, this is right that the recent figures have not been very good in terms of releases in the U.S. economy. Nevertheless, it's not a surprise for us because the European situation has not been very good, as you know. China is slowing down, this is true, but what we think is that the US economy is much more domestic than the rest of the world, and this is the reason why we are very positive on the US economy as a whole, and also because this is one economy where the government has been a drag on the economy recently, and especially on jobs, because the private sector is hiring more and more people, whereas the government is laying off and terminating contracts. So we think that the domestic private sector in the US is doing quite well. This is not a rosy situation, but we are quite positive going forward when it comes to the US economy, much more than for Europe and eventually for emerging markets where it is a mixed bag of situations.
And so how are you incorporating that view into your investment strategy, Pierre? I know that you take a fairly optimistic view of equities. What do you look for in these stocks?
So in terms of stock selection, we are very selective. We can't say that we buy this or this market just because we like the country or the region or the currency. But what we think is that the global economy is still growing, so you have to take profit of this growth in the global economy, which means that you have to be exposed to global companies, consumer staples, but also industrial companies in some sectors. When it comes to the US economy, what we like is the pure domestic players, apart from the big multinationals that I talked about earlier, but we like the domestic companies, for example, like Quanta Services, which is a service provider for utilities, water companies, and oil services companies as well. And we also like very much the domestic regional banking system in the US. So we are investing in our clients' portfolios in an ETF on the regional banks in the US. This is a position that we like very much, just because, once again, the domestic sector, the domestic private sector in the US is doing not that bad, in our view, better than the headlines figures show.
So that means that you're not very concerned about the uncertainty over the fiscal cliff, over the crisis in Europe, and a slowdown in Asia hurting the domestic economy in the US?
Well, we are concerned, obviously, by all these threats, because everything is so interlinked. But the thing is that we think the fiscal cliff is something that will be postponed, it will be talked about, but this is not a cliff. I would rather say that it's a hill that will be that the new government will be facing. Probably some kind of arrangement will be found, and it will not be as difficult as people expect. So that's one thing. When it comes to Europe, I mean, the situation is bad. It's not a surprise. Everybody knows that. But it's not new in historical terms. I mean, in the 90s, at the beginning of the 90s, the European situation was pretty difficult as well. And the European Union faced difficulties at that time in terms of political, economics, banking system as well. So this is not new. And we think that self-preservation of the European politicians will help the situation going forward.
And so, Pierre,
but it will take time.
Sure, I just wanted to pick up on something that you said about being very selective when it comes to stocks. Do you prefer companies with, say, higher dividend yields over corporate bonds, an asset which has been very popular amongst investors over the past year or so?
Well, this is not the same asset class. So bonds are bonds, equities are equities. And if you buy equities for the dividend, you must remind that you are invested in equities, even though they have high dividends. So bonds, we like corporate bonds, of course, but the yields that you get today on corporate bonds are very low. So you have to be aware that when you buy corporate bonds, you won't get the performance that this asset class produced over the last 12 to 24 months. So we like equities with dividends, but this is not the main characteristic that we look for when we buy into equities. What we like is companies that are able to maintain and grow the dividends because they have a safe, very healthy balance sheet. They have a global exposure to clients and customers all over the world. And they are growing. So this is why we don't like very much utilities in Europe, for example.
Tell me, do you prefer emerging market corporate debt to developed markets?
So this is something that we find very interesting, absolutely, because emerging market corporate debt is a new asset class for a very recent asset class. So this provides all the Western countries, pension funds, funds in general, with a new asset class, diversification, new names, and this is something that will keep on being very well regarded from the Western world investors. The thing is that when you get corporate investment-grade companies offering you 50 basis points to 100 basis points more than their equivalent from the Western world, we think this is very attractive.
Yeah, so yields, as you say, a bit higher compared to their equivalent ratings there in some of those Western companies.
Yes.
Well, thank you very much, Pierre Mouton, Portfolio Manager at Natsuki & C. Thank you for your time today.